Welcome to our channel. Today, we will talk about top mistakes in investing you should never make. Investing is a powerful tool for building long-term wealth, but it's easy to fall into common traps that can derail your financial success. Whether you're new to investing or an experienced investor, avoiding mistakes is critical. In this video, we'll walk you through the top mistakes in investing that you should never make, helping you navigate the stock market, build a balanced portfolio, and avoid the pitfalls that many investors fall victim to. Stick around until the end for some essential tips that can help you make smarter decisions and maximize your returns. Before we dive in, don't forget to hit that like button, subscribe, and tap the notification bell so you don't miss out on future videos and managing your finances like a pro. If you've got any questions or suggestions, feel free to drop them in the comments below. I always appreciate your feedback. The first mistake many investors make is diving into the stock market without a clear investment strategy. A lack of planning can lead to poor portfolio management and knee-jerk reactions to market volatility. When you invest, you need to know your financial goals, risk tolerance, and investment horizon. Without a defined strategy, your investments could end up being too risky or not growing as fast as they should. Having a well-defined investment strategy gives you a roadmap, helping you make smarter decisions. Whether you're investing in stocks, bonds, or mutual funds, always ensure your investments align with your financial objectives. Everyone wants to see high returns on their investments, but chasing after them without understanding the associated risks can lead to significant losses. Whether you're investing in penny stocks, speculative assets, or cryptocurrencies, high returns often come with high risks. It's crucial to balance risk management with your desire for growth. Diversify your portfolio with a mix of stocks, bonds, and index funds to spread out your risk. Doing your own research is key to understanding the real potential of your investments. Trying to time the market, buying when prices are low and selling when they're high, is one of the most common mistakes that investors make. The stock market is unpredictable, and even the most experienced investors struggle to consistently time it right. If you're constantly trying to time the market, you may miss out on valuable opportunities or suffer losses from poorly timed trades. Instead, consider using a long-term investing approach, like the buy and hold strategy. Dollar cost averaging is another technique that can reduce risk by allowing you to invest regularly regardless of market conditions, helping you benefit from compound returns over time. Many investors ignore the impact that fees and costs have on their investment returns. Whether it's mutual fund management fees, trading commissions, or hidden costs associated with certain financial products, these expenses can seriously eat into your overall returns. Low-cost index funds and exchange-traded funds, ETFs, are good options to minimize fees. When investing in mutual funds, always check the expense ratio and consider the long-term impact of fees on your returns. High fees can drag down your portfolio's performance over time. Emotions often cloud judgment when it comes to investing. Whether it's panic selling during a market downturn or getting overly excited during a bull market, emotional investing can lead to bad decisions. These impulsive moves often result in buying high and selling low, which is the opposite of what you want to do. The key to avoiding emotional investing is to have a well-thought-out investment plan and stick to it. During market volatility, remember that downturns are a natural part of the market cycle, and long-term investors are often rewarded for their patience. Putting all your eggs in one basket is a classic investing mistake. Failing to diversify your portfolio exposes you to unnecessary risk. By concentrating too heavily on one sector, one stock, or one asset class, you increase the chance of suffering significant losses if that investment performs poorly. Diversification is essential to protect against these risks. By spreading your investments across different asset classes, such as stocks, bonds, real estate, and commodities, you reduce your overall risk and increase the likelihood of more stable returns. This strategy is key to effective portfolio management. Taxes can have a big impact on your investment returns, and failing to account for tax implications is a common mistake. Whether you're paying capital gains taxes when you sell a stock or taxes on dividend income, you need to be aware of how taxes will affect your profits. Consider using tax-advantaged accounts like IRAs, Roth IRAs, or 401ks to reduce your tax burden. Be mindful of the difference between long-term and short-term capital gains, as long-term gains are often taxed at a lower rate. Over time, the performance of different assets in your portfolio can cause your asset allocation to drift away from your original plan. This can increase your risk exposure or reduce the potential for growth. Failing to rebalance your portfolio regularly is a common mistake that can cost you in the long run. Rebalancing involves adjusting your portfolio to maintain your desired asset allocation, ensuring that you're not overexposed to one asset class or sector. Make it a habit to review and rebalance your portfolio at least once a year, or whenever there's significant market movement. Inflation is the silent killer of investment returns. While your investments may grow in nominal terms, inflation can erode the purchasing power of your money over time. If your investments aren't keeping pace with inflation, your wealth may actually be shrinking in real terms. To protect against inflation, consider investing in assets that have historically performed well during inflationary periods. Stocks, real estate, and Treasury inflation-protected securities (TIPS) are examples of investments that can help shield your portfolio from inflation. Patience is one of the most important virtues in investing, but it's also one that many investors lack. It's easy to get frustrated when your investments don't grow as quickly as you'd like, or when the stock market experiences a downturn. This lack of patience often leads to poor decisions, like selling investments prematurely or constantly switching strategies. Remember that investing is a long-term game. The power of compounding works best over time, and staying patient allows you to benefit from steady growth. Avoid frequent trading, which can rack up fees and erode your returns. One of the most dangerous habits in investing is acting on stock tips without doing your own research. Whether it's a hot tip from a friend, social media, or a TV pundit, investing based on hearsay is extremely risky. Many people jump into trending stocks or the latest investment fad without fully understanding the risks involved. Always perform your own due diligence before investing. This includes looking at a company's financial health, industry trends, and market outlook. Make sure any investment fits with your long-term strategy and risk tolerance. Investors often set themselves up for failure by having unrealistic expectations. Some expect to double their money overnight or achieve high returns with no risk. But investing is about steady, long-term growth, not quick profits. Set realistic goals based on your financial situation and investment horizon. Understand that the stock market can be volatile and short-term losses are part of the process. Keeping your expectations grounded will help you stay focused and avoid risky decisions. Before you start investing, it's essential to have an emergency fund. Without one, you might be forced to sell your investments at a loss if you need cash for unexpected expenses. A well-funded emergency account allows you to weather financial storms without disrupting your investment portfolio. Aim to have at least 3 to 6 months' worth of living expenses in an easily accessible savings account before you begin investing. This will give you peace of mind and help you avoid unnecessary withdrawals from your investment accounts. The financial markets are constantly evolving, and staying educated is essential for making informed decisions. Many investors become complacent after they start investing, assuming they know everything they need to know. However, failing to keep up with market trends, Tax law changes or new investment products can lead to poor choices. Make it a habit to stay informed by reading financial news, taking courses, or working with a financial advisor. Regular education helps you stay ahead of market trends and ensures that your investment strategy remains sound. Concentrating all your capital in a single stock or sector is one of the riskiest moves an investor can make. While it's possible to make big gains if the investment performs well, the potential for losses is equally significant. If the stock or sector underperforms, you could lose a large portion of your portfolio's value. The solution is diversification. Spread your investments across various industries, asset classes, and geographical regions to reduce risk. A diversified portfolio is more likely to provide stable returns over the long term. Investing is one of the most effective ways to build wealth, but it's essential to avoid common mistakes that can sabotage your success. By steering clear of these pitfalls and focusing on a disciplined, well-researched approach, you'll be better positioned to achieve your financial goals. If you found this video helpful, don't forget to like, subscribe, and comment below with your thoughts. Let's keep learning and growing our wealth together.